Hey traders, in today's video we will cover deep one of the most important details of successful trading, liquidity trading, and using liquidity sweeps to our advantage. No matter if you are a beginner or an advanced trader, understanding what is liquidity and how it moves, the market is critical for consistent trading profitability. Stay tuned as we explore the significance of liquidity concepts and how they can be used as key confluences to impact a trader's decision. We will also uncover liquidity sweeps and how they can provide very useful information on a market's movement, hopefully increasing your profitability. So if that's something you are interested in, leave a like and subscribe as support to keep up the production of our videos. Alright, let's get into it. To spot and use liquidity concepts, we must first understand what is liquidity. So what is the definition of liquidity? Liquidity refers to large-size trading orders that must be filled. The market is always looking to absorb liquidity from both sides to generate momentum and fuel a trend. Basically, liquidity is the lifeblood of a market. It serves a crucial role in how a market functions and moves by displaying the interest of market participants. Now that we know what liquidity is, the question is, where is the liquidity situated in a certain market? Liquidity can be found on the chart as they are areas of large money standing still in a certain zone. This money is characterized by the traders' buy and sell orders and stop losses. When a trader gets stopped out of a position, the market absorbs that position's value associated with the value of the stop loss. It is regularly speculated that the market is manipulated by central banks and other large financial institutions, moving the market in such a way to deceive traders to take out their stop losses and use their liquidity for large positions executions. It is crucial for us traders to understand where does liquidity sit in such a way to avoid being trapped by traders that work for institutions. Knowing these areas of significant traded volume can provide insights in the market's price action and can prevent substantial losses. Usual areas to find liquidity are above equal highs and above swing highs. The equal highs are important because usually traders that have sold short more often than not, their stop losses are right above the equal highs. And the swing highs are liquidates traders that have open positions in the wrong direction. Because we know that a trending market always breaks highs or lows, depending on the trend the market is following. It is very important to spot what is the market's current trend. Now exactly the opposite happens for the equal lows and swing lows. The incentive of traders is placing their stop losses below the last equal low, so there sits a lot of liquidity. Similarly, the swing lows attract liquidity of the traders trapped in the wrong direction of the trend. Liquidity is also found below and above trend lines. Just like in this example, if a trader has opened a buy with a stop loss below the trend line, this move most likely stopped him out taking his liquidity. This is the psychology of trendline liquidity. Bullish order blocks can also act as liquidity areas, and the same goes for bearish order blocks. Support and resistance zones are also another area to spot liquidity. Don't forget that the zones are dynamic, meaning when the price breaks the resistance, that resistance flips into a support. And when price breaks a support, that support flips into a resistance. These are the basics of the support and resistance, but we will later find out the use case of these areas when liquidity sweeps certain levels just to reverse in the opposite market direction. Liquidity also often stays above, below, and on the close and the open of the previous and current daily candles. This is why, if you observe, there are very frequent aggressive moves with increased momentum when price hits these levels. Now you know it's because of a pool of liquidity that got filled. Let's analyze the liquidity on a real chart. This is the gold chart on the weekly time frame. Looking at the left side, this market was firstly on an uptrend. We can see the formation of higher highs until this exact local high. The second wave of buying pressure couldn't manage to take out the last high, and it peaked lower than the previous local high. Market structure-wise, this is the first and one of the most important clues of swing failure and a potential trend reversal. Right here, the market has changed character from a bullish standpoint to a bearish one. The sentiment of the market was dominated by short sellers. Notice the formation of the trend line. The psychology of traders on a downtrend is simply shorting the upper resistance of the trend line. But that works, until it doesn't. Because short sellers' liquidity gather so much in a short area that market makers execute their orders using the liquidity of the traders that got stopped out. This movement has flipped the gold into a bull market for more than a year. So right here, the gold market has confirmed the change of character from a downtrend to an uptrend. Some would consider this one being a change of character, but it ain't, because a change of character is taken into consideration only when it does take out swing or external levels. So the last swing low that buyers took the liquidity from the sellers is this level. Bull have taken this price up, forming the following ascending trend line. Gold market, the first local high after starting the uptrend, taken a beating down afterwards. But look how they take liquidity of the trend line just to push the price in the opposite way after that is a trend line liquidity sweep. We saw an aggressive move upwards. Remember what aggressive moves cause in a trending market? Order blocks. The order block is the last red candle before the push-up. The upside movement broke the last side. It's called a break of structure, and it indicates continuation of the trend, eventually forming another local high. The market is losing momentum and moving the price into a slow micro downtrend. Notice the creation of another descending trend line. Usually the first breakout of the trend line is a fake out, just to take price in the opposite direction. That happens because the fundamental necessity to move a market is using liquidity. And after the entity that controls the market takes that liquidity, it pushes the price to his way. Here we also have an order block that looks price hasn't mitigated yet. There is also another order block, characterized by the last down movement before the push to the upside. And right here, the break of structure confirming continuation of the bullish market. And gold does the same model again. Descending trend line, breakout, order block formation, break of structure. Before jumping into a live chart example, we need to strongly understand how to analyze the theory of liquidity. Let's look at the following demonstration. As we can see, the market has been in an uptrend breaking structure to the upside. The break of structure confirms the validity of the first demand zone. The first thing we want to do before opening a trade is recognizing the overall trend of the market, which in this situation is a bullish market. After the break of structure, the market creates a local high. Structure-wise, it is higher than the last high, which is the fundamental of the uptrend market. Knowing we have a valid demand zone, we wait for price to mitigate the zone. Firstly, usually the price mitigates a zone after sweeping the liquidity of some traders. In this example, this microstructure has created equal lows. As we have said in the first minutes of the video, the equal lows are a good liquidity sweep area. Price eventually mitigating the demand zone after the liquidation of the equal lows. In an ideal scenario, right after price has hit the demand zone, we should move to lower time frame to observe a change of character that changes the micro trend from bearish to bullish. And for the execution, we usually look for imbalances or extra order blocks or demand zones in the lower time frames as confirmation for the entry. The stop loss is usually placed below the demand zone and the take profit above the last local high on the macro time frame, because we know the uptrend breaks and liquidates past highs. Price pushing to the upside with increased momentum has formed another demand zone, taking the liquidity of the past swing high afterwards. Then the retrace of the price to the downside to gather more liquidity after pushing again very aggressively to the upside. By breaking the last high, the move has confirmed the validity of the next demand zone. Now the question is, what demand zone could traders take and why the upper one has failed to hold? These zones are usually called inducement because it induces traders to believe a specific structure is validated or confirmed. When encountered in such situations, the simple solution can be just taking the lowest demand zone. Or the more complex solution is when the demand zone gets mitigated, switch to a lower time frame. And if the lower time frame doesn't confirm both a change of character, with an execution model entry like an order block or fair value gap, the validity of the area instantly decreases, making it a potential bad choice of entry. Then after mitigation of the lowest demand zone, a price shoots up and liquidates the previous local high. Let's analyze a live chart example. This is the euro-dollar on the 4-hour time frame. Initially, the market has been in an uptrend creating clear higher highs. Knowing that we are in an uptrend, the liquidity is taken from the short sellers. In other market makers usually target to take the stop losses of sellers to fill their buy orders. Look at this move. Constant equal lows on the 4-hour time frame. If we would switch on a lower time frame, there would be even more equal lows to see. Short sellers have a pessimistic look at the market, selling all breakdowns in hopes of a trend reversal. So, what does the price do on an uptrend? Take their stop losses and push higher. This is what is called a liquidation wick, and price broke the highs afterwards high of very increased momentum. This is also a trend line channel where sit a lot of stop losses. Once the trend reverses, price could move like a magnet to those areas to punish greedy bulls. After the prices change character from a bullish market to the first sign of a bearish flip. Now let's move the 1-hour chart and analyze trading opportunities. So the euro-dollar has flipped into a bearish market structure, failing to break past local highs and decreasing in price with a significant momentum. Knowing a downtrend is characterized by a formation of multiple lower lows, we expect the break of structure to happen to the downside. We waited for price to form potential local swing levels, and we marked the high of the range and the low of the range. Price broke up the high. But is this a legitimate breakout or just liquidity sweep? To have the higher probabilities, we switch to a lower time frame to observe how price is behaving. So this is the 5-minute chart. So the macro trend is bearish, but the micro trend is bullish. Usually the higher time frame trend is right, more often. So in our mind, we are a half bearish sentiment for the market to take out the liquidity of the buyers to take the price lower. One of the liquidity areas on this chart sit below this ascending trend line, where probably sit a lot of stop losses of the buyers. We also have the following micro support holding the price. The zone breaks down and it acts as a magnet to liquidate the trend line's stop losses. We could place a sell short position, with the stop loss above the local strong high, and switching back to the 1-hour time frame, the take profit below the local swing low for a decent 3 risk to reward ratio. The premise is simply following the bearish structure of lows being broken, and few hours later this closes as a win. That is it for today's video. We are working on a free course with many more chart examples using all liquidity concepts types, as well as explaining the market structure and trading strategies to learn. So stay tuned for the upcoming uploads in the next weeks or months. Thank you for watching.